Hey everybody, hope you're doing well. Got some interesting things to talk about this week, some interesting data points I want to go over with you. But when putting this chart back together and thinking about the charts that I put in there, I sort of realized there's some underlying basic principles of trading that I was thinking through as I was putting those charts in the chart pack this week. And, it's similar to other chart packs in the past. But I want to make sure and go through on this episode and explain to you from a trading perspective, why I include these things and what I'm thinking, why would I include that data and not say something else? So stick with us and we'll get to some really interesting things this week on This Week in Oil. Hey, I'm Aaron with 30 years of experience in oil trading and analytics, and I'm here to elevate your understanding of the oil market. So let's jump into it right now. All right, here's the chart pack for this week. As usual, we're going to start out with a chart of WTI again, just to see what's going on. Where's the market? Kind of check in with the market like that, if you will. So last week, pretty close to a doji. Again, maybe some would call it a doji, maybe not. But what's really interesting, I thought was super interesting, was on Friday, we actually had a down day. I believe Tuesday was a big down day, and then Wednesday, Thursday kind of recovered most of that price action. We got almost back to where we were on Monday, and then Friday the market sold off again, which I thought was interesting because going into a 3-day weekend, typically you want to go home long, right? Because things can go wrong over the weekend. You could have explosions or you know all sorts of bad things. There's all sorts of geopolitical situations going on in the world right now that I'm sure you're aware of that could suddenly get worse from one day to the next and cause some havoc in the market. So, just as a matter of operation, people usually, if they're short, they lighten up their shorts on Friday going into a 3-day weekend, or if they're long, they usually kind of try to hold that position over a 3-day weekend instead of reducing their exposure to the market. So I just thought that was pretty interesting. The other thing is that the volume last week was pretty low. I've got a chart in the bigger chart pack that I think you might find interesting on that point too, just showing how low total volume was in the month of August. Again, that's not unusual. People take holidays in the month of August, especially in Europe, and that tends to then sort of rub off on the US markets as well. So hopefully now that we're into September, that will, people will be back at their desks, traders will be back on the job a little bit more, back from holiday, and maybe get a little bit more focus in this market. So again, I do have a bigger chart pack. I do have a much more detailed explanation of things. Go to my website, theoilbalance.com, and click on the button that says set me up for a free trial, and I can get you that information. So at any rate, what I want to point out in terms of maybe some very basic trading principles is that you can absolutely trade technicals off of a market so long as you're not getting paradigm shifts in the underlying data. So what do I mean by that? So you can look back here where we had the Israel-Iran conflict. Now that's a paradigm shift, right? You're no longer worried about inventories, at Cushing as much as, well, what happens if the Persian Gulf does get shut down? What happens if they do take out the Strait of Hormuz? Those sort of bigger questions like that suddenly change the focus of the whole market to something different. Now, that situation was, it kind of blew up really quickly and then went away relatively quickly in the terms of, if you think of it in terms of compared to Russia, Ukraine, which is still ongoing all these years later. So then the market after that was sort of left with, okay, now what? What do we get back to? And we were able to draw this downward sloping trend line fairly early on that the market, did a pretty good job holding to. And again, I thought before we had this upward trending line here, that's where I thought maybe we'd get the breakdown towards 55. And I'll go into that here in a minute. But again, during this set of time, the market is pretty much stuck in a range. I hope you can sort of see that. And that's when it's really appropriate to start trading technicals, to start looking at what they're doing, how the market's positioned, the psychology around the positioning, and that sort of thing to maybe get a little bit of an edge on the market, or at least to figure out which way the market's going to try to go next. So if you think about it, one of the things I like to go back to and talk about quite a bit is the OPEC numbers, because that was such a big deal earlier in the year when they came out in March and said, okay, like, as we said before, we're going to increase our production numbers. And then in the April meeting, they said, well, we're really going to ramp up, the frequency. The scale each month is going to get much bigger than we originally planned in the March meeting to bring these barrels back to market. And so at that point in time, back in March and April, the market said, well, there's going to be all these barrels back on the market. It's going to be a disaster. It's totally going to crush the market, that sort of thing. Or you had to go with the narrative of, wow, demand must be super duper strong to sort of be absorbing all these things. There were a few voices out there saying, well, look, there's already overproduction going on, and these increases are just to sort of put a rubber stamp on that overproduction, and things really aren't going to change that much. And it's that group that proved to be true. And I'll admit, you can go back and see the videos that when these things first came out, I was like, man, this is going to crush the market if they do increase production that much. And I think the point is that third group was correct in saying, no, they're just trying to justify the overproduction and maybe, leaving some wiggle room for Saudi to get back some market share, especially in the Asian market and that sort of thing. But by and large, it's not going to be a huge deal at least from a summer standpoint. And so that's why I keep coming back to this data, because you have this initial hypothesis with the information you've been given. And then as the data comes in, you need to see if that hypothesis sort of holds true or not. And I'm going to keep going back to this, just this methodology for trading that I think is important or useful for you guys. So at any rate, the reason I put this in here is to show that exports from the 8, who should be increasing production, based on the headlines and the press releases that they made, it's really not coming through too terribly much in the export numbers that Petrologistics puts out. So again, I really like Petrologistics data. If you're in the industry, please go check them out at petrologistics.com. They're not a sponsor, but I've been using their information for quite a long time, and would highly recommend them to anyone in the market looking for this sort of information. So on this top chart here, you can see, June got pretty spicy in terms of the exports. If you sort of take that out, or let's say June against where it's extra high against January, where it's sort of extra low. Exports this year have pretty much been in this broader band between 21 and 22 million barrels. So again, even if you were to come out and say, well, Petrologistics, their numbers are inflated or too high or whatever, well, fine. Just look at the change in these various months, and you're just not seeing an additional 2.2 million barrels per day into the market. The other argument that I think holds some water, but it needs to be put into the right scope, is the amount of internal burn, especially in the hot summer months. Saudi Arabia does use crude for direct burn. They also use a lot of fuel oil for direct burn. So in other words, to make electricity, they use whatever they have available, which is crude oil, natural gas, fuel oil, etc. And so, that's absolutely a legitimate increase in those things, and they could be increasing production to sort of help offset that. And you also have different religious festivals taking place, especially in the country of Saudi Arabia, that would add demand on gasoline and diesel and that sort of thing. But when you kind of pull that back and then look at the scale, you're talking a couple 100,000 barrels per day differential because of the internal burn or the cooling demand, and then maybe 100,000 barrels per day or so for the increase in transportation demand because of these big religious events. So you're not getting anywhere close to the overall, on paper, the 1.7 or the 2.2 million barrel per day increase, depending exactly how, what time point you're sort of looking at this. So that maybe that's part of it too. On these exports, why they've been relatively low, but the September, October numbers should be pretty interesting, and we'll look for that for validation. So again, just to kind of step back and think about the philosophy of trading here, we're making a hypothesis, and we're going to be looking at future data to prove that out or not. So again, I hope that's not too rudimentary or too fundamental for you, but just kind of want to be pointing out the reasons why I put these charts in here and maybe how they can help you trade. The other thing I think bears looking at is the U.S. is a pretty big exporter of crude oil. So, in the 4 million barrel per day range ish, it's been a little bit lower, obviously, here lately. We don't necessarily have to export, if that makes sense. Yes, we have overproduction. No, we'd have a hard time running those 4 million barrels per day internally, but it's not like we're set up as a nation from a sort of state level to be like someone like Saudi Arabia, or Venezuela, or whatever you want to talk about, where their economy is completely based on making sure they export this crude and sort of maximizing that revenue. Obviously, in the U.S., it's much more company by company based in making that determination. Much more, say, capitalist type paradigm going on there. But the point is that exports actually started slowing through the third quarter that we have so far. Obviously, we only have July and August data in here so far, but we can see, at least from the preliminary August numbers from Petrologistics plus the DOE, the weekly DOE numbers, kind of adding all those up for the third quarter to date, it's definitely looking like OPEC plus US exports are actually going lower quarter on quarter. So yeah, we had this big June number back here from the OPEC 8. We also had pretty decent exports in May and June from the US. And now those are all sort of tending a little bit lower. So again, it's OPEC is a huge contributor to the global market, but there are obviously other countries that export, and it's probably worth taking a look too at what they're doing and sort of in a net basis, what's going on there. So here's the OECD stock. So basically, it's it's Europe and North America OECD. There's only 4 countries in the Asian OECD markets, which I'll show you here in just one second. But from an OPEC perspective, again, this is coming from the OPEC monthly oil report. Inventories up through June, which is the most recent data point we have at the moment from these sources like OPEC or the IEA or Jody, which we'll see here in a minute too. Show inventories are above the 5-year lows, which would have been January of 2022, at least in the first half of the year here. And sort of tending closer to sort of year ago, at least in June here. We were quite a bit away back in April. But you can see also from the chart that usually the declines continue through the summertime, typically bottoming out in September, and then starting to bounce back a little bit in October, maybe November. Again, it sort of depends what's happening that year, with the particulars of what's going on. But the point is, you usually get an end of season low point here in September and some sort of bounce back, at least temporarily. You can get draws further into the winter months as you go on. So just sort of keep an eye on that. But if you think about it, this is the data that OPEC's looking at when they make their decisions. So that's why I wanted to point that out to you. If we look at the Jody data, I guess one more thing real quick. The OPEC OECD numbers are pure commercial numbers, so they're not taking into account any strategic reserves in there. If we look at the Jody data, it does include SPR. So on this chart here on the left, I've actually substituted the weekly commercial stocks for crude oil in here because it makes a nice graph. It makes it easier to see sort of what's going on, apples to apples, at least in terms of volume of inventory. This chart here on the right does include the SPR, and it just kind of shows you how massive the US SPR is and how much we drew since 2020, since the COVID lockdowns and that sort of thing. But the point I'm trying to make on showing you this data, particular and breaking it out between the different regions, is it sure looks to me like these Asian markets so far this year are net increasing, right? You see that little upward slope there. Of course, it's choppy, but it does definitely look like it's upward to me. I believe between Korea and Japan increased 15 million barrels month on month. So a fairly decent increase there. Whereas it looks like obviously the European keeps grinding lower. We had this high back here in 2024 and kind of roughly grinding lower from there. Same thing in the US, a much larger peak in commercial stocks and basically grinding lower from there. But we're starting to see this interesting little increase coming from the Asian market. So why do I point that out? So sort of again, stepping back and talking about more the philosophy side of trading. So as I've been saying in previous videos, and I said earlier in this video, I have a hypothesis that the market's going to try to bottom out in September, October timeframe and maybe test that $55 area. And then we'll kind of see where it goes from there, what happens, what the situation is, and how everything looks, right? So my initial hypothesis is in the next couple of months, we get down to 55. The next hypothesis after that's probably a buying spot, probably a pretty good place to get long again. But we'll see how that works out. So going back to the initial hypothesis, we're probably going to bottom out in the next 2 months or so. I could be putting on, could be buying puts. I could be buying maybe a put spread since there's so much theta involved, too much worth of theta in there. If I was really super confident in it, I could be going short futures, that sort of thing. But so I have this hypothesis, and now I'm looking for the data to either prove me right or prove me wrong. So in this instance, as we saw in the beginning at the very first price chart, it looked like the market had sort of stabilized again and is roughly moving sideways in that range. Maybe it's going to bounce around either side of $65 for a little while here. So I would need some sort of market shift to happen, right? We're looking for that point where the market goes, oh wait, we need to start considering this piece of fundamental information. And so that's what I'm trying to go through and find in the data to prove out my hypothesis. So what I'm saying is it sort of looks like inventories are starting to increase in Asia. So could that be indicative of a turning point in the market? If the Asian market starts looking heavy, is that going to eventually push back on the Western markets, meaning WTI and Brent, saying, "Oh, wait a minute, we need to stop pushing crude to the east because their inventories are starting to build up." So again, to take a bit of a step back, if you look at the latest IEA data, the International Energy Agency, they're reporting they saw 900,000 barrel per day builds in China in the second quarter. Right, so that's some pretty major builds. If you go look at last week's episode, last week's video that we put out, we were talking about some big red flags coming out from the Far East, especially from Sinopec, saying, look, the gasoline and diesel demand in countries nowhere near as strong as we thought. We're going to have to back up. On a separate statement, the central government of China putting out plans, or at least talking about plans, to go back and revamp petrochemical and crude refineries that are 20 years and older, and trying to either scrap them or streamline them and make them more efficient and that sort of thing. Again, sort of, especially on the petroleum side of things, questioning if they actually need that capacity or if the state run, so we'd probably be talking about the teapot refiners at that point. And then, the state run or the state supported refiners is that enough capacity to handle the demands of the country, that sort of thing. So again, some clues that we're getting that maybe demand's not good enough and or supply is overwhelming demand in that region. And that's why I'm showing you this chart here, where it looks like inventories are starting to increase, at least in these OECD countries, which again would be Australia, Japan, Korea, New Zealand on that OECD list. We also mentioned last week in the video that we've seen inventory starting to swell in Singapore. Singapore's like the big trading hub in terms of oil in that region, the big clearing post, if you will. If you have surplus barrels that you need to get rid of, or if you're just looking for an easy way to pick up inventories, say you're short, you need more inventories, probably turn to the Singapore market pretty quick. Platts and Argus make a lot of quotes around the Singapore market, so there's a lot of visibility into what that pricing structure is. Whereas in China itself, it's pretty opaque, at least from a Western standpoint, of what the pricing structure is and all those sorts of things. So um, Singapore is probably your biggest, easiest access market, if that makes sense. So what I've been doing is looking at these sorts of charts each day over the past couple of weeks. Again, looking at global distillate values in distillate and gasoline. Now, there are some inherent issues with doing it this way. The major one is that the Singapore market closes hours and hours and hours before the US markets close. So anything could happen in that time frame, which is why I'm telling you that I'm looking at these on a really consistent basis and find these charts to be pretty representative of what we're seeing. And what we're seeing is the dashed lines, which represent Singapore, are pretty much always on the bottom end of the range, if not the lowest, the second lowest. That's like it is in distillate here on Friday's numbers. Gasoline on Friday, Singapore, gasoline was the cheapest of these big trading hubs that we're looking at, right? So, it's pretty rare for them to be at the very top of the market. But when they're at the very bottom, again, we can make the case that maybe demand's not as strong as everyone had hoped in that market, and there's going to be some inflection point again where the market says, well, this isn't working out like we thought it would. Demand is not really as strong as we thought it was going to be, and then the market starts to sell off. So again, keep going back to that hypothesis, looking for data to either prove or disprove that hypothesis. The reason we do that obviously is, one, you want to make sure you're right, but then if you start getting data that's showing that your initial hypothesis was right, then you can start adding risk to that position, right? The more and more that hypothesis becomes supported by the data, the more likely it is the rest of the market's going to catch on to what you're seeing and start to move the market that way. So again, you can have your initial hypothesis, you can have your initial trades, which are usually relatively low risk, like a put spread. And then as the market starts to maybe wake up to, the pricing structure, the hypothesis that you had, then you start to get momentum, right? As people move in and out of trades that would support that now more widespread hypothesis that you had, that's where you get momentum. Once you get the momentum coming in is when you can add the risk. You can start increasing the volume. I could go from just having put spreads on to start selling futures and that sort of thing, and get a bigger return, a bigger bang for my buck between those two positions. So if that makes sense. Now, the risk to the hypothesis that I've laid out is that sometime between September, October, the market's going to bottom out. We're going to hopefully touch $55, and then we'll sort of go from there. It's probably a buy. That's the hypothesis. The biggest risk to that hypothesis is that could come absolutely true, but the market may be looking beyond that, right? That sometimes it's hard to tell if the market is looking at, this week's data. Is it looking ahead to what's going to happen next month? Is it looking ahead to what's going to happen at the end of the year? And so what I mean by that is the market's going to shift towards heating season. It's Labor Day. I tried to put in some sort of joke about Kathleen Turner and wearing white after Labor Day. If you're of a certain age, you know what I'm talking about. But it's the same sort of thing after Labor Day. It doesn't make a lot of sense to hold on to a long gasoline position because gasoline demand starts coming off, and you also get that transition to a lower RVP gasoline, which is easier to make, and you can add more blend stocks in there. So it's easier to make. There's going to be more of it because you can butanize the gasoline that you've got. et cetera, et cetera. So to hang on to a long gasoline position after Labor Day is not a great idea unless there's mitigating circumstances like a hurricane in the Gulf that's threatening a refinery or something like that. But it's probably a pretty safe bet that the market is now starting to shift. It's like what's the latest it girl, right? We're shifting away from gasoline and we're going to turn to heating season because that's the next big season. What I'm hoping in my hypothesis is that there's time between those two things for the market to go, oh, wait a minute, you know, things are fairly heavy. Inventories building up faster than we thought, at least in the rest of the world, not necessarily in the U.S., but in the rest of the world. Maybe this market does need to come off a little bit. Maybe long start to bail a little bit, looking for a better entry point, that sort of thing. So it's the psychological side of trading that you always need to be considering and worried about. So just to bring that up to good. So to walk through that hypothesis, inventories in pad 1B are very low. This is New York Harbor. This is where the futures are delivered. If you were to, so this is what the futures should be pricing off of, especially as we go into the end of the month, like we just crossed over. So is there time for inventories to build? Yes, it's probably pretty unlikely that we're going to get meaningful builds between now and heating season. Is this a big enough deal to offset my hypothesis that crude's going to go to 55 between now and October? Maybe. One mitigating circumstance in this case is we've had 2 inventories look fairly sufficient. You're going to need that diesel fuel for harvest season, especially in the Midwest in pad 2. So it's good that those inventories are there. So maybe that takes the edge off a little bit. And then the other thing is how quickly do we start to see cooler weather set in? If we were to get like an early blast in October, then I'd probably run out of time for my trade, right? And it's one thing, it's sort of interesting, is the market gets worried about heating season, about now, September, October, and it can get cold once, and the market's okay with that. And then if it warms back up, then that's when, again, things can really dump. So we would need like continuous cold weather, colder than normal weather in Central Atlantic, in the Northeast, for the market that'd be like the super bullish scenario for the long heating oil play, is just cold weather setting in and staying there for October, November, December. So again, watch the weather forecast, and that's where those things sort of come into to play. So again, I hate to keep. Hopefully, I'm not just completely overdoing it by bringing these things up. But even just then, when I said we're going to have to watch the weather forecast again, I had made the hypothesis. I'm looking for confirmation of that hypothesis and what could possibly turn the market, right? So that's what I keep doing every time when I think about these different trades. So here's the recap I made up. Again, it's just primarily looking at the information that I put here in the charts themselves, and not necessarily about the theories of trading or the trading basics that I've been talking about throughout. If you like that sort of thing, though, if you want me to talk more about them and maybe formalize and put in to a more direct chart pack, these theories about trading and how at least I think about it, please let me know in the comments. Again, please like and subscribe. It really does help. All right. Talk to you guys later. Bye.